Hello. Okay. Hello, everyone. Hello, Martina. We have already 3 p.m. and we are ready to start. If you are, Martina, also.
So good afternoon. I will just shortly say thank you very much for this great initiative. Together with Grant Thornton, we became good partners and members this year. They became members of Norwegian Chamber of Commerce. And previously this year, we made together with Nordic Baltic Chambers of Commerce a very good as well seminar about the tax incentives in the beginning of the year. Thank you very much for the good content, and on behalf of all Norwegian, Swedish and Estonian Chambers of Commerce, I want to say thank you for all members that are joining. And for the future, please contact your executive directors if you have any questions or would like to have other thoughts and relevant to your company, so we can discuss and do something for the future. So thank you, and I wish you a good webinar.
Hello, everyone. Thank you, Martina, for introduction and for inviting us to share knowledge in this transfer pricing field. It's somewhat of jazz to us as we work day to day with this, and are very glad to share some practical insights into this subject of transfer pricing in intra-group transactions. So today we will try to share some knowledge on how to mitigate tax risks without creating bureaucracy in your company. So in a way, it is a very brief crash course, so to speak, into transfer pricing. And I'm glad that today here with me are also colleagues Žygintas with already 6 years, right, in this field, and colleague Beata also with more than 3 years experience in transfer pricing. And I work in this field since 2009. So more than 10 years, but not full time. I have also some other tax questions. So it's quite quite interesting field we have, as it is not an exact science. It is not mathematics, not pure economics, but where tax law and economics collide in a way, where you need to have some economic knowledge, some tax law knowledge, and you need to exercise judgment from your taxpayer part, and also tax administration is as well working in this field with their own judgment, and this leads to discussions from time to time. So today we will have 4 parts, and roughly 1 hour is planned, including questions from your side. So please feel free to ask questions in the chat field. You can write those. And in the end, we will dedicate 10-15 minutes to discuss those. If there will remain some questions, you can email me. We will be glad to discuss this also after this event. So the first part will be about key transfer pricing requirements in Lithuania. Then second part, how to assess and calculate TP risks. Žygintas will present that. Third part will be on how to evaluate an adequate level of detail for TP documentation. Beata will brief you through that. And finally, I will share some pragmatic solutions, how to mitigate key TP risks, how to document specific transactions. But first things first, the source of transfer pricing requirements in Lithuania is Finance Ministry order, which dates almost 20 years back to the time when our President Dalia Grybauskaitė was still Minister of Finance. So this order was from that time. It is not new. I hear from time to time some companies are discovering this as quite new field, but it is like 20 years ago already adopted with some modifications. The most recent is from 2021 current version. And what is important to mention is that our national legislation is based on OECD transfer pricing guidelines, same as all the European countries apply, and including European Union and also Norway as well. So we have this common background under which all the local rules are based. And the main purpose of transfer pricing in tax area is to prove to tax authorities that analyzed transaction between associated persons in a group of companies or with shareholders, that such transaction can be also concluded for the same or very similar price, even between completely non-associated persons. So in a way, you must prove that your transactions with related persons can be encountered in free market between completely non-related persons. And of course, you must bear in mind that tax authorities always evaluate skeptically. It is their job, of course, to do so. And if they see some elements to why to object, then of course they will try to prove otherwise. So in a way, it is a lot of a matter of evidence, handling evidence, thinking about what evidence can prove my point, and building TPE documentation on that. Important to mention is that in the Nordic Baltic region, usually small and medium enterprises are exempt from transfer pricing documentation requirements. So companies with less than 250 employees, less than 50 million euro revenue, of course, depending on currency, local currencies exchange rate at the time. And if they have also less than 40 million euro of assets, then usually in this region, they are exempt from transfer pricing. Same goes for Western Europe, and it's only in Latvia and Lithuania where we unfortunately have much stricter rules and much lower thresholds due to our history and somewhat bigger, let's say, lack of trust between institutions and businesses. So in Lithuania, it is, let's say, applicable to much smaller companies because Ministry of Finance back then, 20 years ago, thought that we must have this lower thresholds in order not to allow companies tax avoidance and profit shifting. Yeah. And now to Žygintas, please.
Thank you, Vykintas. Pleasure to be here. So here to talk a little bit about transfer pricing risks. So, as Vykintas mentioned, the risks for transfer pricing in Lithuania are a bit of an important part of our daily lives, especially because our thresholds are indeed quite small, especially when comparing to other Nordic countries. Well, with the exception of Latvia, I guess, in the Nordic Baltic region. So only us and Latvians enjoy such little thresholds. So essentially, transactions above 90,000 euros with foreign companies here in Lithuania have to be formally documented. So this means that the amount of documentations that are being prepared is quite large, and small companies have to partake in preparing these documentations, documenting essentially usually small transactions. So before diving headfirst into preparing time-consuming and often very costly transfer pricing documentations, what we first suggest to start with is taking a step back, assessing the potential risks firstly. So the risk assessment itself usually can be done in two main steps. So the first step is usually to evaluate what sort of risks are we facing in terms of economic part of the business, the amount in euros that could potentially be owed to the tax authority and other sanctions. And the second part of the risk assessment would be evaluating our chances of what is the risk of being audited in the first place by the tax authority. So some things to consider and look out for. So just to start with the economic risk assessment. Between different types of transactions, there are some specifics. So a loan, sale of goods, rent usually have their own way of calculating risks, but just for a basic understanding, basic approach would be as seen in the table here. So if we would, for example, take the loan transaction, 100,000 euro loan that was issued by a Lithuanian entity to a foreign related entity. So it does fall under the documentation threshold, so it should be documented formally through local legislation. But if we look at that transaction at more depth, so the lent amount is 100,000 euros. Yeah, so applying a 5% yearly interest. So if the management assumes that, for example, at the worst case scenario, the tax authorities upon tax audit could assume plus or minus 2% adjustment at the maximum. So this maximum would translate to yearly tax-based correction of 2,000 euros. So applying the 15% Lithuanian corporate income tax rate, so that's only 300 euros. So of course, late payment interest fees and tax penalties do apply in addition to this, but for this specific case, the overall economic tax risks would not be more than a few hundred euros. And in terms of preparing a documentation, that might actually cost the taxpayer thousands of euros potentially, because especially for loans, those are sometimes quite tricky and do require at times the use of quite expensive databases and credit risk assessment tools, which are not cheap and quite cost intensive. So knowing this, the taxpayer can evaluate the whole economics of the arrangement. What are they risking and what to do within legal confines, of course. So In addition to this, as I mentioned, there are also tax penalties to this sum. So recently they have been increased to 20 to 100% of unpaid tax. So this is, of course, a range. So where you end up on this range depends, as usual, on some aggravating circumstances. You can get penalized additionally by actually being placed in the unreliable taxpayer bracket. This is probably the worst sanction that could be placed on you. Usually we do not see this in practice very often. Probably only companies that are asked for transfer pricing documentation to be presented to the tax authorities, but refuse to do so. And prices for their transactions probably seem dubious at best. So probably only then you would be treated as an unreliable taxpayer. But well, for those of you who may not know, in Lithuania, all taxpayers are placed into two different brackets by tax authorities. So the first being reliable taxpayers, where you would want to be, and the second one, unreliable ones, where you would not want to be. So that gives some additional sanctions, but probably the worst of which is being excluded from participating in public tenders. Probably for some companies that may not be such a big deal, but for some industries, for example, construction, that might be actually pretty detrimental to the whole business operation. So something to consider. And the price of non-transfer pricing compliance could, potentially, through this small transaction, seemingly generating very little economic risk, it could generate some bigger repercussions if necessary steps are not taken. So, knowing these economic risks, we can then move on to the second step of evaluating the risk of being audited in the first place. So where to start? First place to look at would probably be the form FR 0528 that is presented and prepared to tax authorities by entities in Lithuania engaging in these transactions that should be documented, meaning over 100,000 euros, over 90,000 euros, sorry. So in this particular example, as we see, the sale of goods transaction has costs that are higher than the income, meaning that the Lithuanian entity sold goods to a foreign related party at a loss. So maybe for a singular year that can happen. As Vykintas mentioned, tax authorities can accept anything that is at market price, and these circumstances will sometimes do happen between unrelated entities when losses are had. But if this goes on for many years, 3, 4, 5, and so on, definitely that would likely raise some red flags and cause for questioning from the tax authorities side. So in addition, this form has one small box to the right side that is often overlooked by taxpayers. Is essentially a small box where you have to check whether transfer pricing method that is legislated by the finance ministry of the 5 listed methods, was it applied, that method? And this code 3 means that no, in fact, we did this transaction with a related entity, but we did not apply a transfer pricing method. So naturally, this would probably beg the question from the tax authorities then, okay, how did you come up with the price? So something to obviously take note of. Other things to look out for are, obviously, as we mentioned, loss-making transactions, but also it could be overall loss-making years, loss being declared in the corporate income tax statement. So again, maybe one loss-making year is not so bad, but if it is a continuing trend for a few years and the company belongs to a big group that is overall doing well and is engaged in significant intergroup transactions, so then naturally investigation might be started to see if these intragroup transactions are not the fault of causing these losses. Another thing that is the unusual culprit is purchases of services that have no evidence of them actually being rendered. So maybe instances of these more traditional services like centralized group accounting, where one entity in the group is responsible for accounting procedures for other foreign entities. And this is usually easy to substantiate to the tax authorities because there is a paper trail for accounting discussion and documents, but often problems arise when management fees are taken from group entities by usually the parent company. So if only management advice is given, strategic plans are made, some administrative assistance, or just general management by the group from the central office, and the fees are being charged for this, then we advise our clients to gather any and all evidence that could help substantiate these transactions and the scope at which they are set to be provided. Gathering all emails, call logs, secondment related documents, and other evidence is obviously a good idea. So another thing to watch out for is interest-free loans, or conversely loans with very high interest rates. So this obviously depends on who is the lender and who is the borrower. So if a Lithuanian entity receives a loan from a related party with zero interest, so no money is leaving Lithuania, and the Lithuanian tax authorities would be okay with it, most likely. But if vice versa occurs and a Lithuanian company issues a loan at zero interest, so obviously that might arouse suspicion. And finally, one of the points to consider when dealing in these type of transactions is if intangibles are involved. So if there are some transfers of royalties or in fact payments for the use of royalties within the group, especially if these recipients of these royalties are in countries that are low tax zones, so that often raises suspicion. And also if there is a transfer of hard-to-value intangibles between group companies, the DAC 6 directive, of which Vykintas will talk about later, would also be into effect, and such types of transactions would have to be declared to the tax authority on a separate form. So obviously tax authorities receiving some sort of paper indicating a high risk transaction might also raise some flags for potential audit or questioning to the very least. So if you do not fall under any of these categories, then most likely you would be fine and not be audited by the tax authorities, as we know the limits of our tax authorities in being able to render and look at each and every one of the small transfer pricing documentations that have to be prepared by numerous companies is usually you just have to lay under the radar and hope for not being audited in the first place. But of course, this does not mean that you do not have to have some sort of preparedness in the form of some documentation. So something to keep in mind. Okay, that should be it from our risk assessment side. So on to establishing a sufficient level of transfer pricing documentation, hopefully at an economic price point for the company. So over to you, Beata.
So thank you for my colleagues for the introduction. And now I want to speak about how to evaluate an adequate level of detail for transfer pricing documentation, also about transfer pricing documentation preparations. So in Lithuania, the procedure of transfer pricing documentation is described in Chapter 5 of the Lithuanian Legal Acts. And transfer pricing documents must contain information relevant to the pricing of transactions available at the time of the transactions. However, if subsequent information may be provided, if it reveals circumstances relevant to the pricing of a controlled transaction, they also can be added. So in transfer pricing, there is two types of the documentation. There is a master file and a local file. The master file is mandatory for the companies if the company or permanent establishment exceed the turnover in Lithuania for the past year exceeded 50 million euro. And the local file is mandatory for the units and permanent establishment if the income exceeded 3 million euro for the past year. And also local file is mandatory for the financial companies, credit institutions, or insurance companies. And if the company's controlled transaction with their if the group companies does not exceed 90,000 euro, the transfer pricing documentation is not required then. So this graphic represents the information that I mentioned before, but I repeat it briefly. So if the company, Lithuanian entity, is performing financial or insurance business, and the transaction with associated companies exceeded 90,000 euro, they are obligated to prepare transfer pricing local file. Also, if the company's turnover reached 3 million euro in the previous year and their transaction with the associated companies exceeded 90,000 euro in past year, they are also obligated to prepare a local file. And also, if companies reached 50 million euro in previous year and the entity belongs to a multinational group of companies, they are obligated to prepare a master file. So Lithuanian legal acts also have a list of items that should be added to the master file and local file, and I will start from the master file list of contents. So master file should contain information and diagrams about organizational or legal structures of the group. Also, it should contain supply chain information of most profitable goods or services. It depends on that what company performs. Also, information on important factors that determining the group profit, and description of major geographical markets, analysis of function that a group performs, and information on significant business organizations, acoustications, and also about significant transaction for the provided controlled services. And also, master file should contain a list of intangible assets, also data on royalties received or payable, R&D strategy, location of R&D equipment, and also information about financing transactions, their general policy, and also information about who carries those transactions, and those transactions are centralized, and functions about these transactions. And also master file should indicate relevant agreements with other countries' tax administration on pricing principle for the future transactions. And if is it possible, the master file should obtain information from the group. It's necessary to indicate the reasons for not receiving the information upon request on the tax authorities. And next is the local file. So the local file must contain the information about controlled transaction and its 5 comparability factors. That is the characteristics of the transactions, functional analysis, terms of transactions, economic circumstances, and business strategy. Also, master file should contain the pricing method and the reasons why this method was chosen. Also, method application information and calculations, selected party and comparative data. Also, local file should have quantitative and qualitative selection steps about the comparative search, also criteria, rejections, reasons, calculations, and adjustments of the search. Also, it should be dates of preparation presented on the local file, also updating dates or this, then some changes of documentation was made. And also, if possible, if you can add other information, for example, for performance analysis and other. So in Lithuania, we should update transfer pricing documentation for each tax period. That also for benchmarking studies, it can be updated at least every 3 years. If the economic conditions in the market do not change. For example, COVID-19 pandemic had a significant impact on the market, so this situation required making benchmarking study. And the deadline for transfer pricing documentation preparation in Lithuania is by the 6th month of the next year, 15th day. So it is the same as deadline for income tax return. For example, if your financial year is starting in the January and ending in the December, the deadline for the next year, it will be 15th of June. Also, if tax authorities are requesting the documentation from your company, you can submit it to the tax authorities within 40 days. And also you can ask for delay of submitting the documentation if you should translate your documentation into Lithuanian language. So it's this all from me, and I'm passing the word for Vykintas.
Thank you, Beata. Thank you, Žygintas. I will carry on through some sharing pragmatic advice on how to proceed with this transfer pricing analysis. And in a nutshell, we can summarize this process as at first analyzing the controlled transaction, meaning the transaction with associated parties that you have intra-group, for example, by assessing 5 comparability factors. We will see what are those in an instant. Then at the second time, let's say, you should search and analyze for comparable internal or external transactions with which to compare. and analyze those also through the same 5 comparability factors. And thirdly, the method should be applied from 5 methods available. What are those comparability factors? Firstly, it is characteristic of property or service being transferred, which must be assessed. Then we should also evaluate what functions, assets, and risks are being performed, managed, or mitigated by parties to this transaction. By performing the functional analysis, which is the most important, one of the most important elements of analysis. And then we must also take into account contractual terms of transaction, which can also be non-written terms, only verbal. It is quite common in Scandinavia as well, in where trust is key. And sometimes it is much more important than a written contract. Then economic circumstances must also be assessed. For example, seasonality, as often when a business is seasonal, you can get completely different prices in spring and in autumn, and you must take into account this aspect as well. And finally, if possible, to evaluate business strategies pursued by the parties, both in your group and in externally with transactions from the market you are trying to compare with. You must also assess those, as for example, entry into market strategy may allow smaller prices to be applied quite normally in this transfer pricing setup as well. Other quite relevant factors which can give some hint as to what can influence pricing is that must evaluate whether loss-making activities are happening, and in some cases, especially manufacturing or selling of goods that you must sell quickly, let's say, it is sometimes better to have some loss, let's say smaller loss now than bigger loss later. So sometimes it is quite possible. You must also take into account state regulation level, local market aspects, business synergies, logistics costs, customs aspects, etc., etc. All these can affect pricing. And let's move on to 5 transfer pricing methods. They are grouped into 2 groups, the so-called traditional methods and transactional methods. And what matters here is that tax authorities also prefer traditional methods, so the first 3 over the transactional profit methods. And when traditional methods can be applied, the first one, comparable uncontrolled price, is the preferred one by the tax authorities usually, even though formally you can choose whichever you believe is reflecting the most accurately the pricing. Other generally accepted methods can also be applied. It is allowed, for example, when evaluating, for example, value of business, then discounted cash flows method can be allowed, and several methods can be also combined to achieve greater reliability. First method, comparable uncontrolled price, is about price in euro per specific unit. So it can be price per kilogram, price per ton, price per barrel, price per something else. and it is quite useful when we have to deal with commodities, for example, or we have two objects very comparable, and we can compare this price per unit. Second method, resale price method, or RPM in abbreviation, deals with gross profit margin. So gross profit divided by revenue, and is most often encountered with distributors business, where the object of the transaction, the goods, are not being modified somehow by the reseller, hence the resale word in the method name. Third method, cost plus, is very widely known, and it is about gross profit markup, meaning gross profit divided by cost of goods sold, and is quite useful for manufacturers, for example, in some other transactions as well. Fourth method, profit split, is very tricky to apply, is similar to joint venture, when intertwined activities being carried by the parties of the transactions, or intangible assets are being used by the parties. It is quite good method, because it allows a perspective of both parties to be taken into account, whilst the first three methods are not looking at whether this is profitable or not to the other party. Tested party can be one, and basically we don't care what is the profit level or loss level at the second party of the transaction. A fifth method is transactional net margin method, and it deals with the EBIT margin, or net cost plus markup profit level indicator, Berry ratio, or other, meaning profitability after operating expenses in most of the cases. And it is quite interesting, as this TNMM method is currently the most widely used, and it examines whether the net margin of a controlled transaction is in line with the arm's length principle. And usually it requires use of specific transfer pricing databases to search for, in a way, peer companies in the industry, but themselves not having affected their pricing with belonging to the groups. And if we can see that, for example, your EBIT margin is 5%, and we see that similar companies in the market have also 5% EBIT margin, then we can conclude based on that, if no other rejection parameters exist, that this is quite good grounds to say that your profitability is at arm's length. So for specific pragmatic reasons, somehow this method is the most widely used today in our practice and in our European colleagues' practice as well. How it looks like, let's say in output deliverable way, you can see that some kind of comparable companies can be found, and based on their profitability, we can end up with some profitability range here, in this case from 4 up to 13% EBIT margin, or return on sales profit level indicator, which hints that company operating in this industry and having transactions with related party is with okay profitability and arm's length if it falls into this range, in this case from 4 up to 13%. This is quite wide range. Usually it's maybe 3% fluctuation into one or another, and we must also eliminate extremes. So minimum value is eliminated and maximum value is eliminated, and statistically we are looking to interval from first to third quartiles of all the statistical indicators of profitability we have in our data set. So this is how it looks like in practice. And now let's move on into some specific types of services. I will share my slides later on because I see that our time is running, so all those slides will be shared, and I will quickly follow through some key aspects of them. So for intragroup services, I would like to draw your attention that at first we must answer a question whether service was actually provided, and do we have evidence that the service was actually provided? Because if not, then tax authorities can reject it in fully, and the expenses for such service will be fully non-deductible for corporate income tax, and also purchase VAT will as well be non-deductible. So companies must hold evidence for services they purchase that such service was actually provided and by the service provider, and economic benefit received by them. And only then we are looking into cost base of such services. What expenses do they include? Whether some providers' shareholder cost was eliminated and not passed to subsidiaries. What allocation keys were applied, whether they are reasonable in this case, and only then we are looking into markup element, which is the smallest in terms of all this amount. Let's move on into some hints about manufacturing transactions. So the comparable uncontrolled price is quite rarely applied, only if there are sufficiently reliable internal or external comparisons, but it is quite rare to find for identical products. So most often we use either cost plus method, especially if there are internal comparables, right? If a company sells both to related and non-related parties, then we can find internal comparables, which are very reliable in most cases, and check whether gross markups earned from that are similar to those earned from sales to non-related parties as well. If such cost plus method application is not possible, then we usually go to the transaction at margin method and perform benchmarking in Amadeus database. In trade or distribution transactions, also the controlled, uncontrolled price method are very rarely used, I must say. Only if we have to deal with commodities mostly, but in most cases we either can try and apply the resale price method, checking gross profit margin that our company earns. With those we can see that are earned in transactions between non-related companies, then it is quite a good comparison. And if this is not possible, then also we shift to the transaction at margin method, checking EBIT margins from similar distributors, traders, and then apply the TNMM method. when we have financing transactions, and nowadays they are becoming more and more important due to sudden and quite dramatic rise in interest rates. Up to now, I would say, usually statistics of the Bank of Lithuania were applied, but now we see the urge into the specialized database to evaluating credit rating by performing qualitative and quantitative analysis of the recipient of financing, and also performing pricing assessment with specific databases to find out what are the possible interest rates to be applied into this transaction. So it is a quite complex exercise. Until now, there were some maybe unofficial rumors that up to €1 million tax authorities would not chase companies for this specialized creditworthiness assessment and databases in financing transactions. But nowadays we see that the shift is happening into requiring this very specific exercise. If, however, the statistics of Bank of Lithuania is used as a first method, then it is crucial to take into account the best suitable table from the statistic of Bank of Lithuania. And there are quite a lot of information, but we need to find the most suitable in your case, and not base our conclusions with some not relevant information. And finally, about intangible assets transactions, they are probably the most tricky, as cross-border transfer of intangibles have a risk of triggering mandatory notification to tax authorities, and also that we must take into account the more complex DEMPE concept, meaning which party is developing the intangible, which party is enhancing this intangible, which party is performing maintenance of the intangible, protection, legal, and which party is exploiting the intangible. This is international concept and requiring additional scrutiny. It is not sufficient to say that under contract this or that party is doing that. We must also verify whether in economic reality it is also happening, whether parties have human and financial resources to do that. And it is the most important step when starting with this intangibles analysis. Usually cost-based methods are not recommended in intangible assets transactions analysis. Profit split method is quite often required and possible, but in practice it is indeed very difficult to apply. And what we can recommend as a practical solution is starting with a royalty range database developed by a Lithuanian company, by the way, which is a good way to start this DEMPE analysis and benchmarking for your intangible transaction. Problem with that maybe is that it doesn't reflect the real value of the intangible, and this is a bit harder to grasp, but it is a good pragmatic way to start with this type of transactions. So that is pretty much it from our side today. Please write your questions into chat, and while waiting to your questions, as some additional resources to between us tax geeks in a way. There are even podcasts about transfer pricing, which are quite fun to listen while driving or commuting to work. So we are sharing the so-called the Fiona Show transfer pricing podcast. Quite good quality and interesting cases, and additional reading always is worthy to read what transfer pricing court cases there are, as Lithuania is a very small country, and currently, as far as I recall, we have only 2 transfer pricing cases in Lithuania, which is of course too small data set, so to speak, to say anything about tax authorities' practice. So we often look into much broader context. And regarding Norway, for example, there are also some interesting cases, such as Statoil case of a couple of years ago, when the Norwegian Supreme Court was deciding upon interest rate to a group company, and the vote was by 1 judge difference in favor of the taxpayer Statoil. So you can see it is not an exact science, and often even judges do not agree on what should be the outcomes, but applying methodology and trying to figure out, we can achieve somewhat bigger certainty and risks mitigation in this area. So please now to your questions, if there are any. If no questions, then I am sharing maybe into this chat field also my email address. Do not hesitate to write to me afterwards also. And Daiva's question, what comparable transactions to choose if the goods on sale are for further sale to institutional clients under tenders? Okay, if I understand correctly, it is that some company is reselling goods purchased from one company to then to institutional clients. So I would start by functional analysis of this reseller, what employees this reseller has, what experience, what know-how, what have this reselling company done. If, for example, this reselling company won a very hard to win tender, then it has some value, and it justifies some markup to be some profit element to be left in such company. And if this reselling company is also buying something from non-related parties and reselling also to institutional clients, then it should be possible to compare gross profit margins. You see, from goods resold that were purchased from non-related clients, suppliers to institutional client. If we see, for example, that gross margin from such resale is, for example, 20%, then we can probably say that this is a good hint as to what gross profit margin can be in the resale of goods purchased from a related company as well. Of course, as comparability factors, you must take into account volumes, seasonality, strategy, maybe also. So some differences can exist, but in a nutshell, I would start by looking for internal comparables if possible, and if not possible to find internal comparables, then of course it might require looking into databases and trying to find some comparables into specific Amadeus database, which complies all the European companies' profit and loss statements, balance sheets, and from those databases we can conclude as to what profitability is reasonable in such cases. I hope it gives some flavor as to where to start analysis, and I'm glad to pursue this discussion if needed after this event as well. So it was our pleasure today to.
Okay, so we see that there is one more question. Just 1 second. Is there a risk from a Lithuania perspective if a firm in Lithuania received a loan from an associated company from outside Lithuania at a lower than arm's length interest rate? How do you document that in a transfer pricing policy? So from a Lithuanian standpoint, that should not be too risky if the interest rate is a bit lower than at arm's length. So probably you should start by investigating if there is a risk from the other side of the transaction that is outside of Lithuania. And if not, then you can document these transactions in Lithuania if you have the obligation to do so. And if the transaction is indeed lower than at arm's length, then documenting it in such a way is possible to the Lithuanian tax authorities. They would not be too mad about it, likely, and would not request a tax adjustment to the benefit of another country. So, but of course, presenting such a documentation meant for the Lithuanian tax authorities, you should not present this documentation to the other countries' specialists. So, also there is a possibility of making some perhaps transfer pricing adjustment to achieve this arm's length rate if that is a possibility. So these options should be considered.
Okay, so it was our pleasure today to be with you to share some insights. Wish you a very good afternoon, and see you during the next events, live or webinar format. And big thanks again to Norwegian Chamber of Commerce, to the Estonian and Swedish Chambers of Commerce for sharing the word, and see you the next time also. Yeah, I can answer one more questions. Yes, from Andrews. If only the local file has to be prepared, how detailed must be the pricing documents for goods or services purchased by local company? Yes, if local file must be prepared, then of course this key information about goods characteristics, functional analysis, and methodology applied must be reflected in the local file. That is the most what matters. So not forget functional analysis, which party is doing what type of function. It can change pricing, and evaluating all the 5 comparability factors. Apply the relevant TP method, present with relevant calculations. This is the most important. And then if you don't have to prepare master file, then you don't have to describe industry analysis. Broader business context becomes less relevant. You can mention it if it affects your pricing, but it is not so crucial in local file context. And what deviations from external prices are considered as acceptable? Well, formally, no deviations there should be, but if there is some kind of deviation, you must have some kind of reasoning behind why is the deviation happening. And the more subjective the deviation, the more chances are that tax authorities will challenge such deviation. So if you see that some deviation is happening, then most often it is a volume discount in my practice. And there are no clear guidelines how to evaluate volume discounts, because of course for a bigger client you will apply some kind of discount. And the question is, in this or that industry, in this or that taxpayer practice, what are the reasonable volume discounts? And the best if you have internal evidence that for similar size clients, you apply similar discounts based on volume, then it makes sense. But again, you can bring forward some other elements of negotiation that would be relevant between non-associated parties. For example, speed of delivery, timing, seasonality, whether it was a business strategy to enter this specific business segment. So all of this can be relevant and must be mentioned as arguments. And again, tax authorities can be looking, of course, skeptically. It is their job, their function. You must be ready for such discussions. And if you can provide some evidence that it is reasonable, hopefully it will pass tax audit. And even though currently we do not see a lot of tax audits in this field, we expect increase, always expect increase because it is growing in importance, this area. And now this year, most likely it will also depend on whether this tax reform will take place, whether budget revenue from bank solidarity contribution will be as planned by the government, and if not such high as planned by the government, then most likely there will be some increased scrutiny also in this transfer pricing area. And finally, Rimantas question about 3 million turnover. So this turnover is about documentation. So when you must prepare written documentation, but formally under law on corporate income tax, you must apply market prices and arm's length level of pricing to all transactions. This means that for smaller transactions and for smaller companies, tax authorities still can challenge and ask to provide evidence in a free form. So in any format, it doesn't have to be in transfer pricing documentation format. So it is, let's say, more flexibility to you. Problem is that deadline is much shorter for that usually. So if for full TP documentation, you have 30 days deadline to provide to tax authorities to answer smaller tax inspectors questions, not full TP documentation. Deadline is usually much shorter. You can also ask always to extend the deadline, especially if it is cross-border transaction and you need to translate something. it is quite a valid argument, translation to ask to extend deadline, but beware that usually those deadlines are shorter than full documentation. So the 3 million threshold allows not to prepare TP documentation, but it doesn't give you a free, let's say, white ticket to do whatever pricing there is willing to be applied. So some economic reasoning must always be behind pricing of all the transactions, even in smaller companies and smaller ones. We can definitely help with brief pragmatic advice over phone for such smaller cases also, and help to navigate in this landscape. For us, it is not rocket science. We deal with it every day, and happy to share, happy to help. So thank you for joining us today, and nice to have this opportunity for this kind of jazz a bit about what we do, and see you next time in Chambers events, and good luck. Have a nice evening, and goodbye.